Money Miners, JD, an absolutely left field conversation we're about to bring you with a fund manager who's going to stay behind a pseudonym, although we are calling him Leon. His name is Leon, but you're not going to be able to see his face. And he's a mystery. And all you need to know about Leon is he's one of the most interesting guys I've spoken to in recent history. And his performance is absolutely off the rails good. In a way,
100%.
in a way where it's like it's up and to the right without the drawdowns. It's one of those miraculous charts.
Leon is a fantastic thinker. He's pretty introspective, as you'll kind of gather from the conversation. He thinks deeply about his sort of process, and he shares a heap of that. We have been itching to do this conversation since we spoke to him a little while ago, so I'm very excited to share this one.
Right before we go to our good friend Leon, JD, Money Miners, many of you probably don't even know we have another medium. It is called the Director Special, and it's a daily, concise note with all of the news that has happened in the mining markets in the last 24 hours.
You want to be up to speed just like Leon is? Sign up to the Director Special.
Go to moneyofmine.com, chuck in your email, hit subscribe, then go to your email, click the confirmation.
Got to confirm it.
You got to confirm it.
Here we go.
JD, you know how I'm a big fan of Twitter. You know that, right?
You are indeed.
So every now and again, come across an account on Twitter that just starts putting some things out into the abyss that speak a hell of a lot of sense. And I reckon about 18 months ago, an account on there called Arrakis Global started speaking a hell of a lot of sense, particularly around Glencore. There was a fair bit going on with Glencore at the moment, and this account and we started talking and we exchanged a few messages, and I realised the person behind the account was a portfolio manager. And we've since come to speak with this portfolio manager a couple of times in the past. And, mate, he's actually an incredibly interesting, thoughtful, independent thinker when it comes to investing in many, many ways. And in particular, he definitely does have a bit of a commodities, real assets bias, but he's a generalist. He thinks holistically about a lot of stuff.
100%. And since we first spoke with Arrakis, or Leon as we're going to call you, I think we turned to each other after that chat and said, got to get him on the show. This is going to be a wicked conversation. And since, everything that's unfolded in the world started playing out over the past month or two, Leon has been posting some really interesting stuff. His positioning in how he's invested in the market is fascinating. So I thought it was the perfect time for us to have him on and speak about some of this. So Leon, we're stoked you've sort of made the call and come on the podcast, and we're very eager to chat about how you're seeing the world.
Gents, absolutely delighted to be on. And I have to, again, commend both of you. I'm a huge fan of the pod. And, with the obvious exception of today, the caliber and quality of your guests is fantastic. And so, excited to chat. And I think the voice that you guys now have in the commodity mining space is really interesting. So well done to you both for building the Money of Mine pod, and delighted to chat.
Butters us up, mate. We're delighted because I think this is your first ever podcast, Leon, and we're delighted to be part of that experience with you. And I think the audience will be as delighted to hear your thoughts as we were since we've been speaking, because you just have a very unique lens on the space. You piece together a lot of different things that aren't just the very generic things that you come across and see. So I hope we get to display your type of thinking on a whole host of things right now. But I'd love to kind of just zoom out and try and get a picture of your investing philosophy, how you actually think of compounding capital in general.
Yeah, thanks, Trav. So you mentioned I have a slight commodities bias. So I started off as an investment banker in metals and mining, actually at a illustrious Aussie shop called Macquarie Capital years ago. And so that was what gave me, a start in commods. But by all intents and purposes, I will effectively trade and buy anything that makes money. So my philosophy is incredibly simple. When I started my fund, I had the guiding principle of don't lose money. And there is something in me physiologically, I don't know what it is, but I absolutely hate losing money. And whilst that maybe sounds very self-obvious as a fund manager, I'm constantly surprised by how blasé and cavalier many fund managers are about losing money. So my investment philosophy is incredibly simple. I start off with the guiding principle of risk management and don't lose money. And then I will touch everything. I like to say I've burnt my fingertips on every stove. So I'll trade currencies, commodities, equities, credit. I'll do anything. So my philosophy is a generalist. It's go anywhere. And what I try and really do is I always start with price. So my guiding philosophy is to try and listen to what the market is telling me. And listening to the market, listening to what the whispers are, right? And really understanding that narrative, price action, fundamentals, flows, market structure, these are not sort of linear boxes that add up. They are fluid systems that all interact. And my philosophy has basically been to try and buy things that go up, cut things really quickly. I am a big fan of resetting your book completely. It can sometimes drive some of my investors a bit nuts who are, asking me like, what are your top convictions? Tell them something, and 5 days later, I've flattened the entire book. But it's something that I've learned to do, and I do more and more. I also don't believe in having this sort of juncture between being a short and a long-term investor. This juncture between a trader and an investor. I think that today it is incumbent upon managers to actually exist between, this is going to sound very Dune now, between different intertemporal spaces as you invest. There can be times when you're thinking long-term, times when you're thinking short-term, parts of the book that you're actually comfortable to sit on. Other times you actually maybe are trading incredibly actively. And so, what I try and do is I try and maintain maximum cognitive flexibility across asset classes, across geographies, to make myself and my investors money. But again, my guiding religion is to not lose money. And as I've grown older, I've become more and more paranoid about risk management, paranoid about cutting stuff. When I started off, I could take drawdowns of 5, 6, 7%. I'm absolutely miserable now. If my book is in a 2% drawdown, it's not good. And I'm usually cutting everything if that's happening. I cut and I reset. I think, what is the market telling me? What am I not listening? What am I not getting? And this is a process I've developed over years, and it's something I always come back to in times where maybe I'm not trading well, or I'm not making money, or I'm not feeling in sync and in flow with the market. So look, maybe that's going to sound way too woo, but that is effectively my investment philosophy.
That flexibility that you speak about, Leon, is that kind of inherent? Is that natural to you, or have you kind of taught yourself that aspect?
Yeah, JD. So I started off like many do as a sort of fundamental investor, right? And for a long time, I used to think charts and all that stuff was just hocus pocus. And the more time I actually spend in the business, the more I actually find myself incorporating lots of different disciplines, right? Technical analysis, momentum, quant stuff. I mean, what was germane to me was the fundamental analysis, right? The sort of steeped in Buffett sort of stuff. But, I think the big problem with a lot of that stuff is that, and I think it's a common mistake that investors make, is they onboard investment philosophies that are not in sync with their initial conditions, right? So as the largest investor in my fund, and my fee structure is a very eat what you kill structure, I cannot lose money on a short-term basis because that's what I actually need the money from my fund to subsist, right? And so for me, the way that I invest money is out of necessity more than out of anything that's germane or in line with my philosophy. It's that I need my NAV to grow month on month. And whatever way and whatever method I need to use to achieve that goal, I do. So, there are times where I'll look at an event type of strategy. There are times where I'm, maybe much more momentum based. I do think market structure and flows, that has become a really big part of my process. I don't like to fight narratives. That's a big no-no for me. If there's a negative narrative in the market and I'm swimming against the tide, no, we're going to cut that stuff, and we're not going to swim against tide. So I'm looking for ideas and themes where there's liquidity. There are lots of different market participants that are going to come into that. The thematic approach is actually a big part of what I do. I'm looking for mega themes, whether that's commods, European defense, AI capex, whatever it is. I'm really looking to catch those themes and catch all of the upside vol and try and minimize the downside vol. But to answer your question, yes, I started off as a fundamental investor, and I've now become this. If I'd looked 10 years ago what I do now, I'd probably be horrified. But we've landed where we are, and I can't really imagine doing things differently. But the market always humbles you, and I will be forced to change style as the market forces us all to do.
Tell us more about that thematic piece. I find that super fascinating. Do you find yourself just jumping in and learning everything you can about, European defense, mining commodities, these sorts of things, and that sort of sticking for a while, or how does that sort of play out?
Yeah, it's a really interesting question. I mean, we're almost going to get into a bit of a epistemological debate about like what initiates a theme, right? How does a theme begin? And I tend to think that you have these. So I like to think a lot in paradigm shifts. So I like to think about when a paradigm actually begins, and I'm always really alert to that being the spark that starts a theme off. So if we take European defense maybe as a good example, the very obvious time when European defense became, an incredible trade. Ironically, obviously, you should have bought all the European defense names as soon as the war in Ukraine started, right? But interestingly, for me, the paradigm shift really happened after the Trump election. And it happened in particular after that. So for me, it was several moments. It was one, that famous meeting with Zelensky at the White House, and it was J.D. Vance lecturing, Friedrich Merz, the German chancellor, at the Munich Security Conference, right? And I think those two things just signaled such a huge shift in. I just felt that was going to be something that was going to become immensely tradable. Now, previously, you'd had Olaf Scholz, who talked about Zeitenwende, which is, but that was years ago. And so some of the names actually did start moving, but they really started moving after that Munich Security Conference and Zelensky-Trump moment. So for me, that's when the paradigm shift started, right? And then it's a question of, okay, we know this trade is now on. It's being confirmed by price. The fundamentals are moving in the right direction. What's the best way of expressing that trade? So it's almost different phases, right? The first phase is we're looking for the existence of that paradigm. People are talking about the theme. The narrative now starts to exist, right? Then it has to be confirmed in price. Super important that it is confirmed in price. And then it's, okay, what are the positions that we're going to put on that are going to allow us to capture this thing in the most sort of liquid, profitable way? And then the theme evolves. You can start to produce alpha within the theme. We could talk about how I think that came about with commods, but it's all really about being aware and just listening to the market narratives. Memory in AI, that was a huge one, right? So I remember listening to guys like Gavin Baker and Josh Wolf, like almost like 2 years ago, talking about memory. So I was in Micron like 2 years ago, found a way to not make money in it 2 years ago. But when I really started paying more attention to it, last year, I said, okay, this thing that I knew could become a theme, the memory, the on-device shift, this is now really going to run, right? And so then you have Micron, you have SanDisk, you have SK Hynix, and it's really about identifying that the paradigm shift has happened, and then you've got to sort of ride that as hard as you can during the period that it's working, obviously.
There's something like about this that I find so interesting, because I notice this in myself, and JD and I do it. Some of our speculating together, a fair bit of it, and oftentimes there's a bit of a tussle, I think, like, because there's a bias that an event has happened and the event is priced in and it's reflected in the prices now. But this philosophy that you have, it's clearly based on the fact that even though an event has happened, this paradigm shift takes duration to play out, where you're going to ride some sort of wave. And I think just like differentiating between the beginning and prices have already changed, but there's a long way to go. It's a really hard thing to do. You never quite know where you are in the duration of that theme. So I'd love to know how you think about that.
Yeah, I mean, it's a great point. So there's a legendary British investor called Anthony Bolton, and he actually talked about something similar. So he talked about really looking at charts and actually, wanting to buy a little bit after the theme had actually sort of already begun. Now, what's really important, I think what you're touching on there, Trav, is one thing that's really dangerous with thematic investing is you don't want to be a late convert to a theme. That's incredibly dangerous, right? You don't want to fight a theme for 2 or 3 years and then finally realize after 2-3 years, oh, this AI thing's actually real and I'm going to start investing in it. Now, you may still make money doing that, right? Because you may still be able to squeeze out some of the juice. But from a behavioral perspective, and I just know this myself, right? Because I've lost money doing this. From a behavioral perspective, when you're a late convert to a theme, you actually tend to get stuck in that what I call broken themes, right? Long after the theme's actually no longer interesting to invest in. By the way, you have to differentiate when something can continue to be socially valid. Something like GLPs, I think, is a great example, right? Like, I totally missed the GLP trade, right? I was a late convert to it, and I looked at Novo Nordisk maybe last year or 2 years ago. I thought, oh, this looks quite cheap, but the chart and the price was just screaming that this thing was done, right? So I bought a little bit, saw how it traded, saw that it wasn't trading well, cut immediately. Years ago, I would have lost a lot of money on that, right? And so the one key thing is you have to try and understand whether you're late or you're early to a theme. And there's no hard or fast way to know whether you're late or early, but you just have to, again, the way that I invest is a very right brain investment philosophy. It's a lot on instinct. And so I look at various indicators to understand if a theme is early or if a theme is late. And by the way, like valuation and flows and all that stuff, that's not going to tell you if a theme is early or late, right? You really want to try and understand. There's the social aspect of understanding, am I early or late in this theme? There is the fundamental aspect. There is the flows aspect. There is the technical aspect and the chart. But I would say the more open-minded you can be, the earlier you can try and catch these themes. But the most important thing is to not be. You want to avoid being a late convert at all costs. And it's always actually a good thing to sort of visit these themes early, right? And so like Rheinmetall, I was messing around in that stock like years ago when the Ukraine war first started, but I missed like the first huge move because I punted it because it just wasn't moving enough for me, right? But I had the muscle memory of knowing, oh yeah, this is the company I need to go and buy to benefit off this, right? Now there'll be people that actually captured the full scope of that move, not me, I'm not going to capture the first 20%. I'm probably not even going to capture the last 20. I'm really looking to capture that middle 60 from these themes. European banks is another theme that I completely missed, right? And so I tried to trade European banks and lost money. So I was like, maybe I'm late to this theme, or I'm a late convert to this. The trade's been working for years. This is dangerous. I got to just stay out of this. So there's safeguards against being late and losing money. By the way, European defense, when you look at how those stocks are trading now, I could actually make a strong argument to say that theme may have run its course. And a key thing that when a theme has run its course is actually when all the fundamentals are really good, the earnings estimates are going up, the brokers are updating and upgrading their price targets, but the price isn't moving. And it's taking more and more extreme headlines to move the price. And that, to me, telegraphs that, we may be towards the mature end of that theme playing out for EU defense, at least.
So what about the commodities theme? What we know and what we love. Where are we? I mean, I think of this as many different kind of cycles because each commodity has its own element. But I'd love to hear you just sort of riff on how you see that.
Yeah, it's a really interesting question. So I totally agree. I see, to the audience that you have that is sophisticated, incredibly knowledgeable about commodities, it can feel wrong to sort of homogenize the whole space as one theme, right? When there's actually lots of different compartments that exist within that, where we're talking about base metals or precious metals or bulks or the energy complex. I think it is important to understand that generalists will tend to sort of homogenize commodities when actually the specialists that listen to your pod will be tearing their hair out and saying these guys have no idea what they're talking about. So I want to be very humble and try not to educate an audience where many people will actually know more than me. But the way that I've been thinking about commodities is fairly simple. So I think 2022 is an incredibly important year. 2022 was a seminal year, at least for me, because it cemented this notion that I had been thinking about, that buy and hold is largely dead, okay? And that there would be a generation of fund managers who had focused on certain factors, certain geographies, a certain style, and that they were going to really struggle. And that they were going to really struggle because they had effectively cordoned off commodities as something that they didn't need to know about. They weren't interested in finding out about. And, 2022 was this seminal year because you saw a lot of fund managers lose a lot of money. And so for me, ever since 22, commodities have just formed a key part of my investment strategy, how I think about the world. And so, that's sort of the background, right? So coming into more recently, and you guys would have seen the letter I sent out to my investors as we closed last year and we started this year, which is there started to appear different narratives around dollar debasement, ex-US, right? Those were the end of US exceptionalism, of some people have referred to it. And I think that, for me, is when I started getting really interested in really upsizing the commods trade in my portfolio. And it's interesting, right? Because it can be great when you actually have a theme that's working across several different narratives, right? So you have ex-US, which is, emerging markets, is going to be a commods heavy type of trade. And then you have dollar debasement, which is going to be hard assets. And so you actually have a theme that's working across lots of different narratives, right? So for me, that was the spark that's really lit the commods trade on fire. And that's really when I supersized the trade, in November, December, and coming into January of this year. But I actually think that commodities since 22 have played, will play, and are just an incredibly important arrow in the quiver of generalists. And I'm still shocked by the number of generalists who just say, like, I'm not touching the space, I don't understand the space. And I laugh. I say, what? You can understand the intricacies of like semiconductors, but you can't understand like digging coal out the ground and selling it, right? It reminds me of this great quote by the Israeli Prime Minister Golda Meir. She said to her cabinet minister, she said, you guys, you shouldn't be so humble because you're not that great, right? And so I think, commodities is something that many generalists could understand. And I think actually it's just going to be a sector that is so important for people to be able to trade, incorporate into their process, and just understand that it's really not something that I think people are going to be able to do without from an allocation perspective with the world as it is since 2020, but especially since 22.
I want to talk about some very recent themes and just like piece together your thinking of these. The first one is front and center of the news every single day, and that's the oil disruptions from an Iran war.
Yeah. So this is maybe a great example that highlights the way that I like to trade and the way that I like to manage risk, but also the way in which I try and interface with the market, right? So, the first thing I do is I don't like calling markets names. I actually never do that, right? Never call markets names, never label markets as complacent, bubble, overvalued. In most cases, there's a very good reason why the market's doing what it's doing. It's just you, meaning me or whoever, you just haven't figured it out yet, right? So I think this oil shock, energy shock, is a really interesting one because I think we've got two separate camps here. We've got one camp that basically says that this is going to be a major bearish event and equity markets need to massively reprice lower, right? And then we got another camp that basically says this is going to be over pretty quickly. We as investors can totally afford to look through it, and it's not worth punting your entire book because actually this can act as a big clearing event and take us higher, right? So there's sort of several competing narratives that are emerging around this, right? My personal take, again, as someone that is hyper attuned to not losing money, has been to approach this with a degree of cautiousness and humility. And so my answer to a lot of the questions is probably going to be, I don't know. And the not knowing actually has to be informed in my risk allocation. So the way I'm viewing this oil and energy shock is that the entire topology of the market across rates, currencies, margins, earnings could be shifting under our feet, right? The tectonic plates of the market and the things that govern market heuristics may be shifting. And so for me to go out there and be adding a lot of risk in this environment is so easy for me to see how I would lose a lot of money doing that. And so at the moment, I've decided to take a really risk-off approach and effectively just wait and see. And it's something which can drive people crazy, right? And it's something I've learned to do in my investing philosophy, which is, I don't really care if I miss a move. I'm happy to buy whatever it is after an initial move, right? If I'm being overly cautious and something goes up 10, 20%, I don't care. I'll find a way of making money in that tape later, right? So that's my current view of this oil shock. I mean, going into it, I had been very attuned to the fact that the market just hadn't. I mean, across different elements, whether that was commods, S&P, tech, I was just very cognizant that for several months, basically since tech since October hasn't really been trending outside of that memory space. And then we had that flush in commods in like late Jan. And, some of the copper names that I've been in, just haven't been trading well. So I was very mindful going into this that, the themes that I've been looking at and wanting to trade hadn't been trading particularly well. So for me, it felt like a very easy thing to go risk off. Now, the response from US markets actually is pretty logical to me, right? A lot of people are wondering, why is S&P not down 20 or 30? Because we're going to have this huge inflationary shock. Well, if you actually think about positioning going into this, like a lot of the Mag 7 were already in a bear, down 25, 30%, right? Like Microsoft was down like 28% going into this. SAS has had the living daylights kicked out of it, right? So the stuff that really took it on the chin was like ex-US, Europe, Japan, Korea, MSCI World. Actually, to be fair, has derated, and it is in the middle of like a derating. It has these, short rallies that it inevitably has been fading. And so if you look at MDAX in Germany, like that's down 8-9%, right? And so in fairness, like stuff has derated, right? But positioning vis-a-vis the US, I think people had been very long, the ex-US hard asset trade, very short the dollar. And so that the US wouldn't collapse immediately on the back of this is sort of actually logical to me, given where positioning was. The big question I have, and I'd be interested in how you guys are seeing this, is, whether or not I would feel comfortable attacking the tape on the long side for some areas like fertilizers, energy, refining, parts of the commod space like, aluminium, sulfur, tungsten, that sort of thing. And then on the short side, I have been playing around in short, UAE, short some European chemical manufacturers, that sort of thing. But again, it's been for quite a small part of the book. My investment philosophy, coming back to that, not losing money, you got to earn your way to trading in these tapes. So if I can do that, and if I can be profitable with 20 to 30% of the book, okay, we'll start to scale that up. But at the moment, I'm very cognizant that the spread of outcomes is wide. And we've had a good start to the year. And I want to be very humble and very, very cautious, but very open-minded as well.
So one of the names we traded a few messages on is Glencore within that space, and you've written about Glencore. It's a name you've had a bit of an association with. So let's kick off a bit of a kind of cold chat with hearing your thoughts. I think you'd written that it was your biggest position, although that might have since changed. But how are you thinking about it right now?
Yeah, it is my biggest position, and it's one that I actually feel fairly comfortable in holding in reasonable size. So I think Glencore is a really interesting one because, I think the management team has, had taken quite a lot of criticism, including from me in the past few years over a variety of things. But effectively, I think what makes Glencore so interesting here is, there may be a vindication of how the management team has actually wanted to position that company with the coal business, the trading business, and the copper business. I see Glencore as being fairly asymmetric here. And it's one of those interesting situations where, my feeling when the stock goes down is I'm very happy to add. It's what I call good volatility, where, I'm comfortable adding, because if this situation gets resolved, I think it can trade much higher on copper beta. And at the same time, if it wants to go lower because, this sort of inflationary shock continues, I think when you look at the coal to gas substitution, especially in Asia, and you look at where, Brent has run, you look at where European nat gas has run, but you look where Newcastle is, you'd probably think that if this all gets worse and gets, extended, that, at least on the thermal side, that has room to run, right? And on the trading side, they've been flexing up their energy trading and nat gas trading business over the last 12 months, which I think is going to prove to be a very, very clever decision. And you would assume that their marketing business will also print. And so I think the management team is aggressive, clever, and thoughtful. They really think like owners. And I think the way they've positioned that company, in contrast to maybe many of the other majors, they are uniquely positioned to actually be a beneficiary of this type of environment. And so I would love for them in April to give us an update on that, on those marketing numbers. I think by way of memory, they printed something like 22 billion of coal EBITDA in 2022, something like 7 billion of marketing revenue. And the copper price is still higher than where it was back then. And so you're looking at an environment where Glencore could really surprise to the upside in this type of tape. And it's ironic and funny that, we may be in the type of tape where the Glencore management just needs to remind everyone that they are also a coal company in addition to a copper company, although they went through great lengths to tell us all that they're a copper company during their investor day. But so Glencore, I feel very good about. I think it's well positioned to do well in many different scenarios. And again, that could change, but that was a name that sort of came to mind quite quickly as this scenario started playing out. I personally, I may be in the minority here. I would love for them to not fold into Rio, because I think there's a unique culture and a unique sort of Glencore way of doing things that I think investors like owning a pure play into that culture, which would, I think, be diluted if they merged with Rio. I was actually very happy when the merger got called off and actually started adding back to the shares then. But again, I may be well in the minority there. Glencore is a name I feel pretty comfortable owning here.
You mentioned 2022 again, and I remember 2023 because that was when all of the private traders had to post their full year results and disclose how many billions in profit they'd made, and in the case of some of the traders, where they're all owned by the traders, with a set number of a very finite number of traders that you could calculate on a per head basis what these businesses were actually making and distributing. And it's the volatility, it's the extreme volatility that just is an absolute gasoline to the profitability of these trading businesses. And Glencore, one of the best publicly listed exposures to that, overlaid with the coal. I love your thinking on it.
Yeah, and again, I think it's there are other ways that you could try and express that view. There's a company listed in the US called BGC, which I think used to be majority owned by Howard Lutnick, and they are one of the, if not the largest, energy, commodities and shipping brokers in the world. That's another name that I have in small size. But yeah, I think you want to own the names that can give you, upside to the chaos, for lack of a better word, right? And again, I want to stress this because we're doing this at a particular moment in time. I'm unclear whether we're in a predator-prey dynamic, which is sort of where the Glencores can really go up, the BGCs can really go up, and the coal names moon, some of the sulfur and fertilizer names do really well, while everything else may struggle, or we're in a more sort of correlation of one type of setup where just everything is going to potentially derate. So, I'm still waiting to see what the market is telling me, and I'm still waiting to see what market heuristic and what market dynamic we're in. But if we are in this sort of predator-prey dynamic, there's going to be so much stuff that you can short, especially going into the the earnings season here in the US. I think there's going to be a lot of pre-announcements coming out that are going to be interesting, and I think there'll be pain there. But as I said, at the moment, I'm trying to earn the right to trade big in this tape. And so, I'm seeing how I feel owning the Glencores, the BGCs, and then I'm trying to look at names on the short side where I think the names are crowded, complacent longs that maybe are, not fully internalizing some of that shifting market topology that we spoke about before.
Can you explain that, earning the right to trade the tape? Is that your parlance for getting a good grip on what this trade is and building your confidence, expressing it, and subsequently, having more positions?
That's exactly it, Trav. So it's really about, it's several things. It's that sensory feeling of when I wake up in the morning and I look at my book, how do I actually feel owning this stuff? How do I feel when it's moving? How do I feel when it's moving up? How do I feel when it's moving slightly against me? I'm really attuned to what is my instinctive reaction to looking at the tape, and am I making money? That's incredibly important. It comes back to, is the allocation that I've built making me money? How am I managing my currency exposure, right? How am I managing my cash exposure? And if that system is working every day and I'm feeling good about it, then I can size up. If it's not working and I'm losing money, then we cut and we go back to, what am I not listening to? What is the market telling me that I'm not being receptive to? That's really what I mean. So, when you go through potential paradigm shifts, and we may be in one now, you have to be really careful and not be too cavalier about putting on a ton of risk and being a bit of a deer in the headlights and actually finding out like, oh, actually, I'm not comfortable with the level of risk I'm running. And by the way, I say all of this because in 2022, I did this all wrong. Okay, so I'm actually giving you the perspective of someone that had a really tough time on the onset of the Russia-Ukraine war. I was not receptive to some really basic market heuristics that, in hindsight, were really obvious. But I shut my brain off to them, and I caused myself more pain than I actually needed to endure. And digging myself out of that was painful. So I'm very cognizant that I don't want to repeat the same mistake. And if it means I miss out on some upside by having too much cash on the sideline, so be it. I'm playing an infinite game in the markets, and there will always be times and setups to make money, right? So I reset my book. I'm earning the right to trade through this tape. Areas to attack, areas. I think you always want to be on the attack in the markets as well. You want to have that aggressive mindset. You never want to be defending parts of your book. You never want to be in a defensive position justifying why I own this name. Now, if you're justifying why you're owning a name and you're fighting a narrative, the way that I manage money, you cut. And then if you want to own that stuff again tomorrow, you can. But that's really what I mean. It's I'm a big fan of tennis, and when you're playing tennis against an opponent and there is a paradigm shift in the middle of the match. I don't know if you guys are tennis players, but you may start to try different things, and you don't want to shift your strategy all of a sudden. You want to work your way into the match, right? Trying certain things, seeing how the opponent responds to certain shots, certain, shifts in pace. And I think it's incredibly important to do the same in the markets, right? Especially when you're in a potentially dangerous setup like what we may be in now.
I think that's a fantastic analogy. That makes so much sense to me and really speaks to me, Leon. I'm really curious when you measure how you're feeling right now. You mentioned Ukraine, Russia, but the other big events in recent history, COVID, if we go back a few years, and obviously Liberation Day last year. So how do the senses you have right now contrast with those moments?
So there's similarities and across all three, JD. I think you're totally right to point them out. So I think So I think as investors, we take on a lot of truisms that are ill-fitting for how to trade today. So I think we embody truisms like, well, it's very hard to time the market, right? You've heard that, right? Don't try and time the market. It's really hard to do, and you just shouldn't do it, right? But actually, in most of the examples that you've just given there, the bad event was actually known ahead of time. We were all told about Liberation Day for weeks. And so COVID is similar in that I remember I was working in a mutual fund at the time, and I had colleagues around the world who were telling me about stuff that was happening. In New York, they'd mobilized the National Guard. In China, liquor shops had run out of, bottles of whiskey and vodka. Hospitals in Italy were full, but at the same time, the market was making sort of new highs in the face of all that news. And similarly for Liberation Day, and actually similarly in the Russia-Ukraine thing, something that really got me in trouble was that I think the Nasdaq actually rallied into that event, and shortly after the first few days of the invasion, I think the Nasdaq was up. And so what you're pointing out is very interesting, and it's a question mark rather than any solution I have, which is in the face of potentially very negative events, there can just be this lag time where the market doesn't react or doesn't decide that it wants to price in the bad event immediately, right? So it's what I call the sort of don't be a hero phase of managing money, which is you have a potentially very negative event. The market is, for one reason or not, it's not pricing that negative event. And for one that is focused really on don't lose money, there is no reason for me to run excess levels of risk. Now, COVID is very interesting because COVID at the time, I was in a much better position to attack that tape because, I had spent a lot of time on companies like Zoom, Slack, Amazon. You remember actually back when SaaS was actually fashionable back then, right? And so when that event happened, I had a pretty good idea of the type of names that were going to work well. And so I was able to attack that tape and actually trade pretty well through that. As I mentioned to you, the Ukraine war, I was very ill-equipped in that particular circumstance. And in Liberation Day, interestingly enough, I was also very heavily cashed up. And I say this to other portfolio managers. I say, I didn't buy any of the Liberation Day dips, but I still had an incredibly good year last year. And it's something that there's a great trader called Michael Platt who runs a fund called, what the fund is called. I think it's called Blue Crest Capital. But he basically says that you don't actually make that much money in the crisis. You make money as you come out of the crisis. So that my learning across COVID, Ukraine, Liberation Day, having traded each one slightly differently, some well, some not well, is the best thing to do is actually to do less. And when the tape actually screams, this is an obvious buy or this is an obvious sell, then I'll get involved. And so I think across all three, my guiding philosophy now is I don't try and buy dips. I try and wait until the tape is stable. I try and wait until the fog of the war is lifted, and then I'll get involved because then I still will be able to make money. There's other stuff to do now. You're getting cash rates across different currencies that is very attractive, right? Especially as a euro-denominated investor. I found areas to park capital and chill out in, for lack of a better word, and actually earn a decent return on cash without having to pull my hair out too much about guessing when the Strait of Hormuz is going to open or not. I think I'm really trying to treat this event like, the COVID event, the Russia war, the April liberation time as let's just wait until the trade becomes really obvious.
If I pull you towards commods again, Leon, how do you think about precious? Its history in the last few years and where it is right now.
Yes, I was very long the gold streamers. By the way, great pod that you guys did with Randy at Wheaton. I thought that was a really great conversation. So, I think that the gold and silver trade was really interesting last year, and especially into the close of last year and coming into January. I was very long names like Franco, Elemental Royalty, Royal Gold, and traded those pretty well. Where I think we've spoken about this in the past, where I've struggled just in terms of conceptualization is the sort of implied market cap of gold versus, let's say, S&P or versus other markets. Now there have been times in the past where the total market cap of gold may have exceeded US stocks, but as of now, I haven't checked the numbers recently, but call it 35-40 trillion, right? And looking at all other US stocks, call it 60 trillion. If gold were to double here, it would be worth more than all US stocks. Again, possible, and I want to be very open-minded to that as an outcome. But to me, gold has lost some of the convexity that it had over the last few years. And so whilst I think it's interesting and it plays a role in portfolio construction, that lack of potential convexity just means that, if I were to revisit, I would size it in a much smaller portion of my risk buckets. So that's kind of how I think about precious. Now, silver, I think, is really interesting because one key thing that I do look at when I'm trading themes is I look at things that are breaking like 30-year price regimes. And that's sort of something that started to actually happen with silver. And so that actually got me really interested. Same kind of reason why I started getting interested in the Nikkei as the year started, right? I'm looking, people say, well, what's he talking about? He's talking about silver and the Nikkei. Well, the common thing is they're breaking like multi-decade pricing regimes. And the charts are actually screaming that there's something fundamentally happening. And I want to be involved in those type of trades, right? Now, Nikkei, again, have to be really careful because this energy shock may have actually derailed that, right? So that's something I don't have on at the moment. So that's really important. If we're in this paradigm shift where, we're going into this inflationary input cost regime, I probably don't want to be long some of those Japanese names anymore. So I want to be very attuned to that. But so to answer your question, yeah, I think the precious thing is very interesting. But I want to see that convexity to get really excited and interested in the trade, Trav.
You shared a chart with us when we were messaging, I think over the weekend it might have been, and again pulling the conversation kind of to the nearer term with commodities, but looking beyond precious, bulks, these sorts of things, where a lot of the metals coming out of Russia, Ukraine, as you've spoken about, they performed very well in the first couple months, and then if you jump forward 1 year, all the outperformance had dissipated and a lot of them had trended down. So how's that kind of informing your view on commodities right now?
Yeah, it's a great question, JG. So I took off a lot of my commods trade, as I had mentioned to you guys when we spoke in January. The hairs at the back of my neck had started to go up, and indicators like how many times are people checking their NAVs in the fund, how many times am I looking at my account, had started going up. And so I had actually started taking off a lot of the commods at that point in time. So it's important. And by the way, there was that big flush, right? And some of the names, like, your copper names, platinum, they'd actually started to trade less well even before the war started a few weeks ago. So I'm very mindful of the fact that there was a little bit of a shift, and these things didn't that they had actually started to trade a little bit less well. So then you have this war, and they trade even less well, and I think that makes a lot of sense. You had a lot of hot money that chased commods, and positioning short term was a little bit fuller. I actually think at the margin I would be a buyer of weakness in some of that stuff here, because I think the big difference between now and the Ukraine conflict is, yes, I mean, if we go into this doomsday scenario of huge inflationary market paradigm where central banks are having to raise rates, it's not going to be good for some of these metals, right? But against that, we've had a reconfirmation of this recurring problem that nations have, which is, it's less of a supply issue, but a problem of access and who has the commodity. And again, this Iranian war has just highlighted the fact that many countries are just short their own sovereignty. And so I actually think we are in a multi-year bull market for commodities. And if they want to weaken significantly on this Iranian conflict, I'd actually be a buyer of a lot of that stuff again, whether that's platinum, copper, gold, silver. I just buy the whole thing. But I'm also very mindful, as you mentioned, that they had an initial rally after Ukraine, Russia, and then they collapsed. I mean, you have to also bear in mind we had like 14 rate hikes over that period of time. That is something that we haven't discussed, but I think is going to be very important, is looking at central bank reaction functions to this thing. And so, before I get very aggressive on the metals, I'm going to want to look at that, right? Because if we're having this conversation about like dollar debasement, but actually central banks start tightening and protecting the currencies, I mean, let's see how that theme does, right? So I stay very open-minded. I'm long-term very bullish on commodities, and instinctively, I probably want to be a buyer of that stuff if it goes down a lot. But I do think looking at central bank reaction functions is going to be pretty important.
The part of the equation that you spoke to before of toying around, there's the 2022 Playbook, FERTs, a big part of that. Like I just remember those stocks just like quadrupling in some instances in 2022. And it feels like a very realistic possibility. I'm just kind of curious, like, what does it take for you to build confidence and express a trade like that? What do you have to see to get comfortable?
So I think the one thing that's prevented me from going absolutely huge in this stuff is really the improvisational quality of the US administration. And maybe I'm being generous by saying improvisational quality, but it is effectively that, some of this stuff is going to trade badly if they find a quick off ramp to this scenario. And again, I'm not a geopolitical expert, and so there's no real value add in me, waxing lyrical about the different probability trees that could happen with off ramps and on ramps and how they negotiate with Iran, and what Nash equilibrium exists or doesn't exist between the US and Iran. But what I can tell you is if there is an off ramp to the conflict and that happens quickly, like the diesel refiners, the fertilizers, the energy names, I'll be very surprised if they trade well into that sort of headline risk. And so the difference between now and that Ukraine 2022 scenario is that just the geopolitical setup and the more predictive nature of how the Biden administration was approaching the problem, the European response and what was happening with Russia was just felt like something. I can't quite put it into words, but it just felt like the spread of probabilities was more narrow than what we face now, right? Especially from a headline perspective. Okay. And again, some of your listeners who are very knowledgeable about the physical side of commodities will say, this is what we're seeing on the physical side. It's not reflected on screen. And my response is that's fine, but I'm trading the stuff on screen. So if there's a tweet that comes out and I'm long oil and oil goes down 15% and that's 10% of my NAV, that's not good. So I have to respect that. I have to respect the headline risk. And that is the reason why I'm not huge in that stuff. Now, playing the other side, what is really interesting is if you look at every differential between the crude price on the screen and what you're actually paying at the pump, right? Every single one of those differentials has totally blown out, right? And I think, to me, that there is an opportunity there, because I think as more generalists start to pay attention to the blowout of all of those differentials, because obviously you're not paying, crude futures when you go to the pump, right? It goes without saying. There's a big difference between that and diesel. But I think that as more generalists actually start internalizing that, and as the market may start to internalize that, that 2022 playbook may actually start to be something I feel more comfortable in. So, I have been playing around in your Archer, Daniel Midlands, your Sasol's, Glencores. There are interesting names that I'm attacking from the long side, but it's 2, 3, 4% of NAV max, right? That again, the reason I'm not maxing out that trade is simply because I respect the headlines can send us much lower. And as I mentioned to you guys at the start of our conversation, I have no appetite to take like an intraday 4% drawdown in NAV. And that can happen if you're massively long that stuff. Look, if you're super convicted and you have a very strong view of where this is all going to go, fine, you can run that type of book. I don't have that conviction. And so for me, it's about getting little wins, earning the right to trade. And if the regime really cements itself that we are in that world, then I'll boost position sizes and I'll go bigger in that stuff.
Your comments on diesel there, Leon, they make me think of that fantastic meme of the person at the pump trying to pump paper into the car to get it cranking. It's a real problem people are facing around the world right now. As we kind of come to a bit of a close soon, Leon, I'm very curious. You wrote this fantastic thread on embracing life as a trader, I think is the best way to kind of encapsulate it. And it might have been 9 or 10 kind of parts to it, but I'd love to know what kind of spurred you putting pen to paper on encapsulating how you view the world in a sense.
Thanks, JD. I'm glad it resonated. It's an interesting one. I think that when you live and breathe markets, the neuroplasticity of your brain actually starts to change when you do this every day for years and years. And I was on a long haul flight and I just decided, I was just thinking about it, and I thought to myself, I'll just write down the various ways that I've noticed that it's actually changed me as a person, and I'd actually say mostly for the better. I'm very, very interested in the inner game of trading and learning how to listen to that inner voice. What is that inner voice actually telling you, right? You guys know it, right? Because you trade your books, and it's something which actually in the investment management business, it's a bit of a taboo subject, I'd say. like we want to present ourselves in an incredibly sort of left-brained, analytical, Cartesian profession, when I actually think a lot of the edge is how we rewire our neuroplasticity, how we lean into our instinctive abilities, our ability to sort of take in all of these empirical data points and then learn how to act on them. And as you live and breathe this stuff as a trader, it affects other areas of your life. In my case, it's made me much more open-minded to other ways of thinking, other people's viewpoints, simply because in markets, if I'm not super open-minded, more often than not, I either lose money or I miss out on great trades because I'm closed-minded to stuff. And so, if that's happening in markets and I have to force myself to think differently in markets, I actually find that it's reflected in life. The volatility of life, and having been someone that was earning a salary for many years, and now I basically live off of what I make on my P&L. It's allowed me to embrace the volatility and the vicissitudes of life in a much more relaxed way. I think, and you guys are entrepreneurs, so you know this, right? But I think the various ways that people seek to suppress life volatility, and stuff hits them out of nowhere, and it can become really traumatic and difficult for them to cope with. I think when you live in the markets as an investor, or especially a trader, you develop good muscle memory on how to deal with that stuff. And I think it's something that trading has really taught me, is learning how to embrace risk, learning how to be really open-minded, learning how to take chances on stuff. And if you're willing to take chances on the screen and with your book, take chances in your life and try stuff out, right? So my approach to risk, how I deal with people, being open-minded, investing and trading has really helped me a lot to deal with that stuff. And that's an ongoing process, by the way. So that thread was really sort of me just putting pen to paper on some of those thoughts that had been sort of bubbling to the surface. Look, it's not and again, I say this to people, it's not a life for everyone, right? You have to live and breathe this stuff. But for those of us that do live and breathe this stuff, that are never switching off, those are some of the things that actually came to mind.
It's one last tweet I wanted to bring up, Leon, because I think you might even be able to tie in some of these like reflections. And I want to bring it up because you put this out there and you gave no explanation. You said Illumina was the biggest loser of my entire career, cost me 7 figures personally. It was one line, no elaboration. So tell me the story.
So one thing that I live and breathe by, and it might drive some people nuts when I say this, is a key red flag for me is when I start to learn too much about an industry or a single name. Ideally, I want to know actually not that much about the name or the industry, because that means I'm usually making money and I'm not worried about it.
Yeah.
When I start to learn a lot about a name or a particular industry, it's usually because I've had to figure out why I'm losing money. And so the sad thing about Illumina is I actually know a lot about the business. I know a lot about gene sequencing because I lost so much money on it. So look, I'm probably the worst biotech life sciences investor out there. So anytime I tweet or I talk to you guys about a biotech name, you have 100% guarantee that you guys can go short, because I'm the ultra contra indicator for that industry. But it hasn't stopped me from trying, right? So Illumina is such a great lesson on many, many fronts. So it's a great lesson in borrowed conviction. It's a great lesson in thesis creep. It's a great lesson in not obeying strong price signals. It's a great lesson in, coming back to that Glencore example of actually liking and respecting management, not paying attention to that stuff. So yeah, Illumina was an incredibly painful loss. I don't know where you want me to start, but effectively that idea came about through this incredible growth investor called James Anderson, who ran a fund called the Scottish Mortgage Trust at Baillie Gifford. I really recommend, if your mining listeners are not familiar with him, they should actually go and look him up, because I think he's an incredible investor who's made money in everything from Amazon, Tencent, Tesla, SpaceX, Vale, Fiat Chrysler, Barclays. Like, he's an incredible generalist. And he had started talking about gene sequencing and Illumina as a really interesting company that could, cause revolutionary changes to, diagnostics for cancer, and that would actually start to have this sort of amazing Rubicon crossing of data with synthetic biology, and potentially being sort of, the first sort of $1 trillion life sciences company. So he had started talking a lot about the company. I'd started reading about it, and I put the position on. This was in, I think it was in late 2020 or early 21, I started putting the position on. They had an incredibly interesting company called Grail, which was, it's actually a public company now. And Grail effectively is what we call a multi-cancer early detection company, where you basically take a blood draw, and you're able from the blood draw to start to diagnose certain cancers much early on. So things like, pancreas cancer, we don't have standard screens for. But the promise of Grail that, a lot of us got really excited about was that you were actually going to be able to start detecting some of these cancers much earlier. And if you can detect these cancers at stage 1 or stage 2, it does make a big difference in the survival rate. Okay. So Illumina had spun off Grail, and in late 21, I believe they bought back Grail for like 4 times the amount that they'd spun it off. So, okay, first red flag, not great capital allocation. But this is where the borrowed conviction comes in, which is, James Anderson actually started talking about how promising it would be to mix the cancer detection with all the sequencing data that Illumina gets, right? And Illumina at the time had a global monopoly on gene sequencing. And so it had been this incredible business, and the promise of Grail and Illumina was incredibly enticing and appealing to me. So I made that a really big position. And I had outsourced some of my thinking to, other very smart investors that I trusted. Big mistake. Then what happened is, the EU Commission actually blocked the Grail Illumina deal, right? Another red flag, something that wasn't confirming the thesis. And that management team decided to do the deal anyway, despite the fact that the EU had told them we're blocking the deal. So then they got involved in a huge amount of regulatory morass. It was a massive distraction to the management team. Then you had the Chinese market that started slowing down a lot for sequencing. And then we collided with sort of the paradigm shift of, an inflationary rate hiking environment. And that stock went from like $500 to sub 100, right? And I think I finally cut the name in the 120s. And, the way that I manage money now is, if I was holding that thing in the $500 and it went to like 450, I would cut that name immediately now. And I'd have it on my radar and I'd be ready to revisit it. But I'd be cutting it aggressively to zero revisit. Maybe I start it again. If it falls down again, I cut it again. As the thesis gets disconfirmed, as the price action screams, as what's happening in the fundamental world is screaming that, you are wrong. Right? If you own something at $500 and it goes to sub 100, you got it wrong, right? Right. And that company's actually never come back. So look, it was a painful lesson. Don't borrow conviction. If you instinctively don't trust management and they're doing things that don't make sense, sell. If price is screaming that you're wrong, you're probably wrong. A great exercise if you're long something and the price isn't confirming your thesis is you should just sell and try go short and see how you feel, see what happens. So all these tools in the toolbox I've developed since then. But yeah, that was my most painful loss, and touch wood, we don't repeat that again. If I ever pitch you guys a biotech long, you're buying me beers next time I'm in Perth, because I would have given you guys a great short candidate.
I'm not tempted to buy a biotech, but your heuristics of when to cut, I feel like I've got to cut most of my portfolio now. So.
Lay on a short and see how we feel about some of those names. Leon, this has been fantastic. I really, have enjoyed hearing how you see the world, how you trade, how you constantly look to improve. And yeah, thank you for making your podcast debut with us. It's been hugely enjoyable.
Gents, thanks so much. Keep up the great work. I think Money of Mine is going to continue in its ascendancy as more generalists flock to commodities. And I think, again, as I say, I think you guys have created a really interesting and exciting platform. Kudos to you both, and excited for where you guys take this. And again, thanks for having me on. Absolute pleasure. Big fan of the show. This conversation's been great fun. Thanks so much.
Thank you.
Thanks, Leon. I appreciate it. Huge thank you to Sandvik Ground Support, NatGen, Intralinks, and Focus, the platform by Market Tech.
Hooroo.
Hooroo.
Now remember, I'm an idiot. JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.